first thing to keep in mind in an election year where there is bound to be a lot of volatility is that one should have a certain amount of her portfolio in cash. Because if you don't have cash in your hand, then you cannot utilize this wild swings in the market. If you're 100% invested, then your die is already cast, and regardless of whether the market falls 10% or 20%, you're unable to participate in that kind of a panic phase. So in an election year, in a volatile year, keep 15 to 20% of your portfolio in cash, at least 15 to 20%. The other thing to keep in mind is that all historical evidence tells you that in phases of great volatility, particularly in election years, high beta and low quality stocks usually don't do well. And therefore, while it is tempting to talk about buying mid caps and small caps in 2019 because they have fallen such a lot in the previous year and underperformed, one should be very careful about going down that path. What works in highly volatile phases are blue chip stocks, high quality stocks, good balance sheet stocks, and stocks with high quality management. So make your list. Typically, the moment volatility comes into the market, people go to the Asian Paints and HULs and Infosys or TCSs of the world and park their money there. So this is a year where you have to be stock specific and you have to focus on high quality, abandon high beta and low quality, and keep some cash in your portfolio. Now, hedging is not for the lay investor. This is for sophisticated investors. Basically, by hedging, what one means is when you are approaching an important event like the election and you know that chances are that the markets will turn volatile and the outcome cannot be predicted accurately, what you want to do is basically buy some insurance for your portfolio. So you don't sell out your stocks, but you buy some products which will basically mitigate your losses in the portfolio, notional losses in your portfolio, by actually capitalizing on any kind of a sharp downswing. What you need to do is to consult maybe your brokers or learned friends and ask them how to buy options which protect your portfolio. Basically, the simplest rule is to be able to buy some put options, which basically you make money on when the markets go down. Now, the premium that you pay on the put option is actually minuscule, but if the market falls a lot, that minuscule amount will actually transform into some significant gains and offset much of the notional losses that you might be encountering on your portfolio. So it sounds very fancy, but it's actually quite simple. But as little bit of a use of the futures and options market around the major events of this year might actually be a very, very good advice to keep your portfolio in good health. Now, this is a very important question to ponder over, because we've seen that in past election cycles, in a single day, markets can go up or down 10% and then actually trend for a while along that path. Therefore, movements can be very significant in a very short span of time. The first thing that investors should tell themselves is that they will not act in panic, because when a market index falls 10%, many stocks fall 20% in a single day. But those may actually just be notional losses because the market has been surprised by the outcome of an event. What one needs to do is take a few deep breaths and say these are not actual losses till I book them. These may be just notional losses. So the idea in such volatility is to stay calm, not to press the panic button and sell out of the market, but rather consider using the 15-20% of cash which you've been recommended to keep in your portfolio to put it into good use. Because often these turn out on hindsight to be very significant buying opportunities, particularly volatility which is induced by political outcomes, because politics does not affect the fundamentals of stocks beyond a point. So short story, do not panic and sell out in the midst of volatility. Do not take precipitate actions. Try and use the cash in your portfolio when the markets turn very volatile to reap better returns in future months and years.